a good investment for the typical value investor. If you like the stuff that I'm putting out, it'd be great if you could like the videos and subscribe. I'm aiming to be one of the few videos on the internet that I found that actually spread factual information and not just people going into crazy technical analyses on stock charts or pushing their own bags on people and inevitably dumping on them later on. Yeah, so it's been a couple of days since my last episode about Me International Group. This time I've got, I think I've got a really interesting company that you guys might like the look of. It's not for me to say whether you should or shouldn't invest or whether I will or won't. This is, again, the research that I would be doing as part of my own checks on a company to figure out whether it's something I can see as having potential to invest in. I try and keep it simple. I try and keep it technical, term free where possible. And again, it's not financial advice. This is just some of the research that I would be doing anyway for my own portfolio purposes. And it's something that I hope that you guys find valuable too, and it should save you a little bit of time if you are out there and looking for potential options of stocks. Let's dive into it then, shall we? The first company that I'm going to look at today, and the only company actually, because I think it's going to take some time to get into, the first company that I want to have a look at is Supreme PLC, which is a UK sales company based in the UK that sells to UK and Ireland, and further afield than that, we can go into that. It sells a range of products actually, ranging from, as we can see here, vaping, lighting, batteries, health and wellness, so protein shakes and things like that, and distributes them across various parts of Europe and the UK. Supreme Imports is sort of the main trading company. As I said, it's Supreme PLC, which is listed on the AIM, which should tell you something. If you're not familiar, AIM is a sort of subset of the London Stock Exchange, where typically you'll find the lower end market cap type companies with potential for growth, but that doesn't necessarily mean they're all an absolute winner. If you like, they can go down just as much as they can go up. So first thing, as I did in the previous one, is have a flick through the company website and see what it's sort of saying and get a feel for what the company is. One thing I find very interesting about Supreme Imports is their business model, and this can be part of the reason that it's going through the period that it's going through, which we can dive into later when I get into the actual balance sheet and profit and loss and things. But the company is very interestingly structured, and it's not unique by any stretch, but it's positioned itself with vertical integration, which is essentially it owns all parts of the manufacturing and sales and distribution process from start to finish on a lot of its products, which means it can keep costs low, and its barrier to entry on certain markets is very low. So it makes it quite a penetrating company with whatever products it has. It also has a lot of interesting agreements with big retailers. So with this sort of vertical integration setup, as well as these partnerships, it can actually feed products quite cheaply and very quickly into markets with a big footfall, and therefore can generate profits quite quickly on new products, which I think makes it really, really interesting. If we go down a bit more, we can see that they do all these are the sort of partnerships they have. We see JCB, we see Energizer, we see the vapes. The vapes is very interesting, and it will develop as this video goes on, and this is the reason why I picked this stock today to talk about, because it's such an interesting one. The vaping makes up the core part of the company revenue, which we can come on to a bit more, but that's just a fact worth holding in the back of your mind. And this is why sometimes looking at the macro or wider economic picture of a company as well as the micro detail in the balance sheet, profit and loss, etc., can be so useful, because one thing might be telling you something completely different to the other. But we can come on to that in a bit after we go through my sort of first check. So first check to the website, looks great. If you go into the videos that show you about the business structure, you can learn some bits there, but I've done that for you. And like I've said, their route to market can be cheap. They've broken down barriers of entry, and they can get to dense markets quickly. So for me, we've got a big tick on the viability side so far. If we go back up to the top here, if we start by looking at the market cap, we can see here that the market cap is 151.5 million. Market cap, for those who aren't sure, is what basically the company is valued at. The sum total of all of its shares times by the share price to give you the market cap, sorry. Generally, as I said before on my first video, generally the market cap is something I look at first, because I like to find companies in the range of 100 million to 1.1 billion at the very top. The reason I don't go below 100 generally is because you can run into liquidity issues when you try and buy and sell shares when you need to, and the last thing you want to do is be holding a losing share and not be able to shift because the markets are liquid. Because not all shares are winners, and anyone who tells you otherwise is lying to you. I'm sorry to tell you, but they're lying. Not everyone is picking winners every single time, but doing the good research can definitely help. On the other end of the scale, the 1.1 billion, again, I don't like going above that, because it just leaves limited, not limited, it's the wrong word, it leaves less room for big growth. The growth has already been priced in, or it's already gone through a spell of growth, and it's sitting at a very, very healthy market cap. And to go exponentially up from there, it would need a big change. And it's just from what I'm looking at for my portfolios, I like to see companies with a bit of growth in them that still got those fundamentals behind them. So there we go. If we look at 151.5 million, perfect. It's right in there. So that's another tick for me. The next is I like to look at the balance sheet. So if we go down here, I'll take you to this graphic first. The balance sheet in a very simplistic form. I quite like this visual because it's so easy to just pick up and read what it's telling you straight away. There's no needing for understanding debits and credits, etc., etc. So what we can see here, just very simply, and as always, guys, keep it simple. What are the numbers telling you? And you can see here that the short-term assets outweigh the short-term liabilities. That's great, but more so, the short-term assets far outweigh the long-term liabilities. And if you scroll up a little bit here, the interest covering ratio is 15x, which means the company can cover the interest that it's got payable on debts quite comfortably, which means any sort of downturns or anything like that, the company will be able to fund them quite quickly and not run into trouble, which will ultimately affect the share price when news about that comes out, or the company has to seek extra finance and it sort of gets into a bit of a spiral. So balance sheet looks really, really healthy. And if we scroll down here, you sort of get a bit more of a broken down one. In terms of cash, nearly 5 million in cash, 20 million, slightly less liquid, but 21.8 million is great. 30 million in stock, and then debtors, receivables in new money, of 30 again. Then we come over here to the debt of 10.9, and don't be scared is put in red, if just to play into people's view of what debt is, because it can be dangerous. But as I've said before, companies and everybody can utilize debt properly to grow and make more money. Only the very lucky can use their own capital to start off with to make more money. So I'm never put off by a company that is holding debt. You just need to really make sure that they can afford the debt repayments and they've got money in the back pocket for rainy days. And to me, it is just as simple as that. There's no science or formula here that's gonna sway me otherwise. I just look at the numbers. look at the balance sheet, and that's telling me it's healthy, as at the latest company accounting date. So that's another tick for me, putting that balance sheet to the test. The next criteria I like to look for is just a general muse around the company profit and loss and the revenue. And I don't like to break it down. I don't need to know what a company's profit and loss is line by line. That's not what I'm looking for. What I'm really looking for is revenue going up? Is the company profitable? And how long has this been going on? Like I said, I'll never buy a company that's not made a profit yet, but is guaranteeing you profits in the future. I see people making this mistake all the time, going for these flashy new tech or new environmentally friendly focused companies that aren't making profits, heavily relied on grants and things like that, and aren't actually viable businesses yet. Whilst that might be a super long-term play that you're looking for, this is not value investing in the sort of timescale that I'm looking for, which could be anywhere from 3 months to 2 years or beyond, depending on what sort of company you're looking at and where your portfolio risk is sat. Okay, so let's dive into it then. So latest accounting period shows that the revenue's at 196.04 million, and it's really helpful on Simply Wall Street because it will break that down to you with the revenue streams. So as you can see, a large chunk of that, is made by the sales of vaping. And again, hold that in your mind, because that's very good to know that the company has broken into a very fast growing sector. Whether or not you agree with what that sector is doing and the ethics behind that, that's not what I'm here to discuss. You can by all means have a portfolio which is 100% ethical and in line with your moral compass, and that if that works for you and that's what you want, who am I to fault that? What I do is like to keep it objective, especially with my own money, is just look at the facts and keep it simple. That said, when you look at companies with those sort of different dynamics from an ethical sense, it will bring in a number of other factors from a macro sense, which I'll come on to later. So again, hold that vaping revenue proportion in your mind. Anyway, this filters through, very lovely little flow, nice diagram, nice colours, but ultimately what you're looking for is the crunch of, are there earnings? Yes, there are earnings, and they're nearly 18 million, which is great. So if we pull this, I like this one because it's just a straight line, and anybody can read a straight line and keep it as simple as that. Has revenue gone up since 2018? I think, guys, you don't need an economics degree for me to tell you that it has gone up. Earnings have stayed relatively stable, but again, starting at around 4 million, 10, 9 around the COVID time, so it still did well over COVID, and then up to 17.9 million in earnings, which is great. So it ticks that box in terms of past performance, current performance. Is revenue is it making revenue? Is it delivering growth in revenue, which is showing continued innovation, continued management of debt properly, continued management of costs properly, breaking into new markets, dominating sectors, penetrating new sectors, which is what this company is demonstrating and telling me that it's doing right now. And over the last 30th of September 22 to 30th of September 2023, it's gone up 60 million. So that's a fair chunk of growth in earnings over the last over that period. So that's another tick. So we've got market cap tick, balance sheet tick, profit and loss tick, website and company structure tick. Sorry, I didn't put that at the beginning. I forgot which order I've done it in, but they're all ticks, so we don't have to panic too much. My next consideration is looking at the company dividends and their dividend structure, and whether there's consistency there and whether they can afford to pay them. Generally, it's not. I don't buy stocks for dividends. Generally, they're just an added bonus if you own one when they come out. But it's more the indication of what dividends tell you. Dividends tell you that one, the company is profitable and it's distributing its profits back to shareholders. If they're consistently rising, it's showing you that the company's growing and it's rewarding its shareholders in that growth and taking them along for the journey. If they're sporadic, it can indicate changes in management or just changes in philosophy or problems with the business and the performance of the business. Now, as we've seen, the performance of the business has been going up here. Don't worry about these. These are simply Wall Street kind of criteria, and it can kind of overwhelm you with information. I really rate Simply Wall Street. I plugged it in my last video. I'll plug it again. It makes things super simple. There's a lot of information there, some of it relevant, some of it not so relevant, but what I'm trying to do is just bring you what I look for in my research and hopefully transmit that to you on what's important and sift out all the other noise, really. Okay, so let's go down to this chart. We can get rid of. Let's just start with the basics and keep it simple. When was a dividend paid? And as we can see, this first dividend was paid on December 16, 2021 at 0.022 as an interim. Then September 22. So what we can see here is a sporadic level of payments and interim dividends and dates. I think that's an amber flag. It's a young-ish company in terms of this being listed on the AIM. It's very early on. It's only a 150 market cap, so I wouldn't rule out the company based on this. What I'd love to have seen is a very nice steady growth of dividends, but we've had COVID, the company came out that, then it's listed on the AIM, and now it's distributing some profits. Whether or not they are consistent gives me a little bit of a note in the back of my mind, something to hold on to and potentially revisit, or not yet pull the trigger on purchasing a share, but you need all the facts and you can't ignore negatives of a company. Doesn't mean you won't buy it, but you need to go into purchasing any share with your eyes wide open on what the risks are and if you accept the risks or not. And to me, this wouldn't put me off purchasing it, but going to purchase it changes the risk sort of factor of this share to me marginally. So if we carry on going down, I think it's probably important with this company that I didn't go into so much on the last one, but this one in particular is just having a look at the management structure and who's in charge, and then go into that a little bit because that will come out in the wash in the subsequent macro considerations later on in this video. So what we've got here is Sandeep is his name, Sandeep Chadha, who is the CEO of the company. He is paid a compensation of 232k. I don't pay too much don't pay too much attention to what a CEO is paid unless it's absolutely wild or sporadic or for some reason. But Sandy is the CEO and director of Supreme. He owns 33.94% of it and has a holding of 51 million. So he very much is the ultimate beneficial owner. He is the guy in charge and it's his company, so he's got skin in the game as well. So to me, that's a positive in the sense of when someone's got that much skin in the game, every pound they earn, every pound they lose, that hurts their pocket. So that's worth knowing, I think, in the scheme of things. So if we scroll down now, so we know that Sandeep is the CEO and he owns nearly 34%. So if we look at the ownership and then move that through to insider transactions, these always tell you a story, and they're an absolute must, guys, on reviewing each transaction that's happened over the last 12 months with the insiders, because they can tell you a lot about what's going on internally. Whilst not giving you the full picture, they can tell you that there's something going on beyond what meets the eye. and that's exactly what we'll discuss now. So I'll start with shares sold. Whilst there are none, this is always an indication of a red flag indication to me, because if somebody on the inside is dumping a lot of shares, and it's quite recently happened, you need to be extra cautious on whether you want to proceed in buying this company, because if the CEO is dumping a load of shares, there's something on the horizon, or there's something going on that might indicate a drop in share price in the future. It doesn't always. You can't ever make categorical statements like that. But investing is all about making the right decisions, making simple decisions. And if something's glaring in you off the page, or hitting you in the face like a wet fish and saying everyone's selling their shares, you might want to think twice about whether you buy it. And I caveat that because it all depends on the proportion of their shareholding that they're selling. If they're selling a massive chunk of their shares, then yes, you need to have a deep dive and be a bit concerned and have that red flag well and truly raised. If they're selling off a few here and there, or a very small percentage of what they actually own, it could just be to free up some cash for themselves and get themselves that nice house in the south of France or whatever they're looking at, or buying their daughter a new oboe. Who knows? But it's not quite so much of a risk, but you do need to make sure you look at it carefully. So in relation to this, what we do have is a purchase of shares of around £463,000, about 390,000 shares were bought by our CEO, Mr. Chada, which is, to me, another good sign and a green flag of an indication that this guy is putting more skin in the game, and there's a potential that they view that the share price might be going up. And in tying it back to the vaping and the industry, the industries and sectors that this company sell to, that could be an awareness or an understanding of regulation that's in the pipeline, or just new business acquisition deals that are on the horizon that other people wouldn't know about. And yeah, so there's a lot that could be behind it. We'll never know. But what you can do is just read the information that's there and glean that and use that in the most effective way possible. Okay, great. So to me, Supreme so far is tick, 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 tick. I haven't, other than the dividends, I haven't seen anything that's been a massive concern. And dividends, again, we know it's got the cash to pay dividends. We know it's newly listed on the AIM. So that's not a red flag, but it is not a full tick in my mind. But let's continue. The next criteria I always look for in a company is, we can come back to this actually because this is quite interesting, but the next metric that I find very useful is the price to earnings ratio. Now, the price to earnings ratio is essentially a price tag on the company's stock compared to how much the company actually makes. So it's telling you, it doesn't price in future growth, but it's essentially a ratio that tells you how the market kind of prices the company. And so in that sense, if you have a high PE ratio, you're looking at a company that might be a little bit bloated in price, or might have already had the market and the big movers already get a big chunk of it and take that PE ratio way up. So the share price compared to what it actually earns is a lot higher, which makes it less attractive. On the other end of the scale, a low PE means that the market might be undervaluing it, or that it's making a lot of money compared to its share price, and there's opportunity there, whether or not that it's actually undervalued, and that's correct, you don't know. But what it will show you is that what the market is valued it in relation to its actual earnings. And because this company's market cap is relatively low and it is profitable, you've got that PE ratio there of 8.4. What I look for, it's not hard and fast rule, but it's somewhere between 10 and 12 on the lower end, and somewhere between 25, 27 at the higher end. Anything that falls between that is kind of a good company. that's got enough growth priced in that you can be a little bit more confident that the market sees it and believes the growth is coming, as opposed to just being completely ignored for whatever reason, which might give you a sniff that something's wrong. Anything too high means you're either a bit late or the company is way overvalued in my mind, and the growth has already been priced in. So 8.4 kind of sits underneath that. It's not quite in that 10 to 12 metric range, but I'm not going to go against what I'm saying, but what it is showing you is that there might be growth in this company, but it is, to me, like I touched on before, if it's too low and it's either undervalued or there's something going on that's not quite immediate to the eye, and I think that might be what I'm going to come on to in a bit. So it's not a red flag. It's just below what I'm usually comfortable in doing. So at this moment in time, would I buy? Hard to say, but I've got, again, in the tick columns, I've got the things I've spoken about. In the not so confident columns, I've got the PE ratio and the dividends. I touched on this on the last video, where I think it's very useful to have a look at what a company's PE ratio is compared to some of its peers, and simply Wall Street's so helpful with that, because it chucks them all together for you and makes it very, very clear. What we've got here is Supreme sitting well below the peer average at 20.1, and even further below companies like Likewise Group and Headland Group, etc., which are deemed to be similar corporates. So again, you've got two ways of looking at that. Two ways of interpreting it. It's either undervalued and there's a lot of growth to be coming, or the market and investors think that there might be something underlying at the moment that's making people hesitant to buy. And that, honestly, is where I'm kind of sat, but I'll come on to why. At the moment, it's just objective research, but never take things at face value. Always question them and always say, what is this telling me? And always be assured to be aware of yourself when you are facing confirmation bias, because it's very easy to fall in love with a stock because you like the product, it looks modern, it's slick, it's exactly what you want for your portfolio, it's got loads of growth potential. You need to make sure that everything you're reading is actually reading it objectively. And what this is objectively telling me is the company is potentially undervalued, or there's a reason for that. And that's why I think I did a bit more digging with this one, and why I've done a video about it, because I find it so much. I found it really, really interesting. So we'll come on to that. So they're my general tests. The last one I like to do, I didn't name it before, but it's called, in my mind, it's called the Milli Billy test. I like to picture myself as being say I'm Conor McGregor, and walk in with an untold amount of money, with a ridiculous watch on, an unbelievable swagger, and a chain that makes my neck hurt. What I'm not interested in, if I'm Conor McGregor, I am not interested in a company that is going to make me my money back, but only do that in the next 50 years. I'm already rich. I don't need that level of slow growth and slow return. I want a company that's going to deliver for me, but in a reasonable amount of time where it makes sense for me. So one way to test that I like is to make sure that profits are the profits are no less than 15 times less than the market cap. So make sure the market cap is 15 times more than what the profit of the company is. So if we go down to the profit, which is 17.95, go back up to the market cap, which is 151, so we divide that by 17.95, that gives you 8.44, which is well under the 15 times Milli Billy rule. So Conor McGregor can go and buy the company outright, and if it does nothing, from the earnings that he'd get each year, he'd be able to pay himself back, break even in 8 years, which is quite low and quite a quick turnaround, even with the projected growth and everything like that. So that's a tick for me. Okay, so let's summarize. Market cap, correct, in the right range. Brilliant balance sheet, really positive. Could even do with a bit more debt to fund some growth, but doesn't need it. It's very, very healthy. Profits are growing, revenue is growing, and it's been profit making since that show. Dividends are an amber flag. I'm not convinced because of the consistency of them. However, I'm not completely deterred. Price earning ratio is below what I generally look for. So is that telling me that there's something wrong with this company, or is it telling me that the market's missed a glaring opportunity here? And the Milli test, straight in, 8.4, yes, tick that off. So okay, so that's the objective research. Let's dig in a bit more on the points that I've touched on that are in the amber section, particularly the PE ratio of 8.4. If you can remember back to the start of this video, I said pay attention to how the profit, the revenue of the company is generated. As we can see here, 196 million of the revenue, 86.42 of that is from vaping. Now, if we go back to the website, we click on the vaping section, and we can see that they've got a wide range of vaping products, and it's a very successful part of their business, and they provide you a range of different products within the vaping sphere. I don't vape, but I know every man and their dog is currently doing it, and I know that there's been a lot of backlash about the safety and the lack of regulation around it, which is the point I'm going to come on to now. So, right, the company is big into vaping and makes a lot of money from selling vapes. That's great. What does the vaping landscape look like at the moment from a macro sense in the wider economy? What we have at the moment in the UK is a Tory government whose policy is not to fully crack down on disposable vapes and things like that, but certainly apply a bit more regulation to it and make it a little bit harder and a little bit less easy to access, which may dent or harm growth going forwards. But if the Tory government stay in, then I can't see it being too much of a barrier for this company to continue growing and manoeuvring through the regulations as it's brought out. What is interesting is that on the 4th of July, the UK is going to have a general election, which is going to bring in the battle, as it always is in the UK, two-horse race between the Tories and Labour. Now, you're not going to be surprised when I tell you that Labour's policy is going to be to place a 2-year ban on a lot of the types of vapes that are out there and make it prescription only for a lot of the types of vapes that are out there. And their ultimate goal is going to be to make it very, very difficult and make a very high barrier for people to obtain vaping products. Whether you agree with that or not, that's not the purpose of this video. Whether you are a Labour or a Tory voter, that's not the purpose of this video. The purpose of this video is to give you all the facts, the economic climate, the political climate, and how that works in conjunction with the stock that I'm reviewing. So what we have is an election that's coming up on the 4th of July where it's currently looking, or certainly murmurs are, and a lot of the news papers will have you believe that it's going to be close, but it might end up being a Labour government. Now, if it ends up being a Labour government and these restrictions comes in, a large portion of the revenue for Supreme may become obsolete. It may be difficult. It might not be able to sell anywhere near as many vapes as it might want to if a Labour government comes in. And this can potentially kneecap this company quite significantly if there is a change in government in July this year. Now, it's not going to surprise you that after doing a bit more digging on this, I found an article which showed that our man, Mr. Chada, had made a 350 grand donation to the Conservatives, to the Tory government, which they've said isn't for any sort of political swaying or anything like that, but the facts are the facts, and I'm a cynical man, whether it's Conservative or Labour. Anyone who pays a political party that much money and has a company that's heavily intertwined with a product that would be damaged by the other political party coming in, and also can benefit from the current political party being in power, to me is making a very bold statement that they know that the landscape politically weighs heavily on the future and the way this company is going to go look going forwards. So what I see there is, for me, keeping it simple, is a very contingent event which is going to affect the share price either positively or negatively. That doesn't mean you can't invest in it. It doesn't mean that it's a bad buy. It's got the fundamentals of the balance sheet and the revenue behind it. But if you're going to buy a company like this, you're going to need to know the key dates that are going to effectively change the share price for the better or for the worse. If we get to the 4th of July and the Tory government stays in place, I imagine there will be a spike in share price potentially, or at least a continuation of growth in share price, because it's likely that regulation will not be as heavy-handed as a Labour government. So conceptually and theoretically, for me, there's a couple of routes you can take with purchasing this in this, and it all depends on your risk appetite. For me, it's a bit risky for my portfolio, probably, but I might consider putting a little bit of money into it based on a couple of factors, which I'll go through. So, and it's all to do with timing. So you could buy this company, shares in this company tomorrow, and by doing so, you're placing a bet on the election on the 4th of July. So you either are looking to sell it just before that election, or ride out the election and hope that the Conservative government stays in. Because if it's Conservative government stays in, I think share price will go up, and that will be almost a green light for investors to say, look, we've got at least another 4 years of selling vaping products and making money from this company. If Labour come in, the share price will dip. So you either buy it then and ride out the political election night, and that might be a stressful time for you beyond your political sway on that day, or there's a different way to go with it, which is wait for the election results come in, and then whilst you might not make as big a profit if the Conservative government stayed in, but if the result is on the 4th of July that the Conservative government stays in, buy it then. And be earlier than most still, and ride a bit of a wave on the share price there. Or if it's conversely, if it's the Labour government that get in, the share price dips, you know the fundamentals of the company, you know what the balance sheet's got. It's got room, it's got cash, it can manoeuvre and grow and merge, and it's also got 4 other half-decent revenue streams and a very solid vertical integration business model. So if you see a dipping share price when the Labour government gets in, it doesn't mean it's the end of the company. There might be an opportunity at that point to put some money in when the shares dipped and hit it around its bottom, because the company can maneuver quite quickly and pivot into something else and stay successful. But I think it's a highly contingent play, which I certainly would not be taking on from my value portfolio. This is slightly higher in my in my risk, above my risk threshold, to be honest. But for you, like I said, this is not for me to tell you whether to invest or not. This video is for me to tell you what is going on with the company, what are the fundamentals, what are the micro figures, what are the macro circumstances, and give you the information. As long as you keep it simple and know what risks you're taking when you do it, you can be wrong and have the best stock in the world, but just don't lie to yourself and don't give yourself confirmation bias just because you like it. Know what's on the horizon and know what you're doing and why you're doing it, and have yourself a plan in place. For me personally, it's probably one that I'll keep on the watch list, and see how the political landscape looks as it progresses through the year. I like the company. I like its fundamentals. I think it's an untapped market, but it is a potentially volatile market with regulation on the way. So you do have to be careful before you dump a load of money onto it. So that is everything from me, guys. I hope you found that as useful as I did. As I said, this is research that I would be doing myself. I screen some stocks in advance, granted, but I still don't know whether they're going to be winners and losers before I go through it on these videos with you. So I'm learning at the same time as you are, but for some sort of prepping, looking at some articles and things that I have to do for the wider research pieces. But generally, I like to use this as my own research too, so I hope that's helped. And if it has been useful, please do subscribe. Every little helps with that, so it is appreciated, or like the video. And if you have any stocks of yourself that you're watching yourself and you want to know what my opinion is on them, and the fundamentals and the backdrop to everything, and give you some objective research on that, I can do it for you. Just let me know in the comments, guys. And it would be great to get an interaction going on that front too. So yeah, good luck with it. Let me know how you're getting on with your own stuff, and I'll see you again soon. And keep it simple, guys.